So, my name is Larry Kane. I'm a partner in Orrick's technology group practice group. And I just got an email from somebody in the group. Okay, ignore that. So, a little background on Orrick's TCG group. So, Orrick is an international firm, but it focuses on three areas: technology, energy, and finance. I'm in the technology practice group. I have a quick slide to give you a sense of how international the practice group is and how many deals we do. Represent 2,700 technology companies, 365 venture VC type clients. I think in 2019 we did $18.9 billion of venture financings. And $29.6 billion of M&A deals. I think the main point on this slide is that we see lots of deals from early stage all the way through unicorn stage. And as we go through the slides, if I go too fast, please ask a question. I like to usually we do this presentation in person, and I try to give lots of examples and make this a discussion. And if somebody has a specific question, they're working on a financing now, as we go through the slides, please ask it, because I'm sure the question that you have, somebody else may have. Next slide, Amir. Next slide. Can you hear me? Okay. Next slide. Okay. All right. So what we're going to talk about today is seed financings. And sometimes we hear the word pre-seed, but the form of a seed finance. And so I'm not going to make that distinction. The real differences between a pre-seed and a seed financing is really valuations, but generally the legal and economic terms are basically the same. Today there are three basic forms of seed financings. One is convertible notes. Two is convertible equity. People often will use the term safes or KISSes. And then there's a priced round called a Series C preferred stock. And I'm just going to briefly say what they are, and then we'll get into more specifics and going through it. But convertible note is very simply a note that will, a debt instrument. You take, say Amir's got a startup and he wants $100,000. He'll take that as a convertible note, which is technically debt. And that will accrue interest and look like any other loan instrument. But if and when you get to an equity financing that's priced, it will automatically convert into that equity financing, usually at a discount or a cap valuation. A convertible equity instrument, or a SAFE or a KISS, and KISS is just a form of a SAFE that 500 startups started years ago. It's got a little more meat to the terms and a little more probably investor friendly. But generally, the difference between a convertible note and a SAFE or a convertible equity certificate is that it starts off as equity and it's not debt on the balance sheet, and it will convert into preferred stock at the time you do a future financing. Series C preferred stock is actually a direct sale of stock, and so you will price the stock. You will set all the terms of the preferred stock and amend your charter and issue a stock instrument. So the legal work between the convertible note and the convertible equity is a lot more on a priced Series C preferred stock. And we'll get into all the pros and cons of the different things, different instruments in a moment. I just want to give you a sense of what they are. The one question I just want to answer right now is common stock. Because I have a lot of early stage investors say, well, why don't I just sell common stock? We already have it authorized in the charter. Why don't I just sell common stock? And generally, there are two primary reasons why we don't see common stock used for seed financings. First of all, the investors are going to want to have preferential rights on getting their money out, meaning that they're putting their hard money in. They want their hard money out first before the sweat equity comes in. So in general, you're going to have an investor's perspective that their investment will have to come out first. And then on the converse side, entrepreneurs need to be very protective of the value of their common stock. And so usually there are two problems that often happen. The first problem is founders will start their company and they're moving really fast, and they may have not done all their paperwork and got their common stock issued to their team or to themselves. And if you start selling common stock to investors at a much higher valuation, you've now priced that common stock, and you can't issue common stock to an investor, say at $1 a share, and then issue common stock to a founder or an investor, advisor or somebody at like a penny a share. There's a tax implication that difference in value must be compensation to the founder. And so it's really important that if you are going to be looking to do seed financing and you're still trying to, fill out your founding team or your advisors or whatever, that you protect the value of the common by keeping it low. If you price it and sell it to an investor at a higher price, then you're going to have to price all your other advisors and everybody else at the common, the investor, your founders or your advisors at that higher common price. So there's a tax issue there if you price it to investors at a higher price, and two, there's an inability to actually attract new talent, because if you were going to tell a new co-founder or somebody that's going to join you, hey, I'll give you 10% of the company, but meantime you've just valued the company, say I'll make a low value, $1 million. That's still $100,000 for that person to come in to join the company for 10% of the company. I just want to stop at that moment in time. Does anybody have a question about why not common stock? All right. Next slide. Okay. So why do we have convertible notes and safes? So the principal reasons why you see a convertible note or safe is that it's a lot simpler than a priced round. You generally just have potentially a purchase agreement or a note purchase agreement. Sometimes you just have a note or a safe. So the number of documents is very limited. In the documents themselves, you have very limited reps and warranties from the company. Maybe that you're just in good standing, been duly incorporated, but really basic reps and warranties. With a Series C preferred stock deal, you'll have more reps and warranties. And does everybody, and to understand what a rep and warranty is, it's basically a promise that your company has these things at the moment of time of the sale. The other main thing why it's cheaper is that it basically punts a lot of the typical protections that an institutional investor will want to a later date. And it basically says to those investors, you'll have a most favored nations clause. Whatever the future investors get on a priced round, you're going to get those. But right now, let's just spend the money on getting the money into the company and growing the business, and we'll deal with those legal rights when we do a priced round. Another advantage of a safe or a note, and this is not necessarily always an advantage over a Series Seed round, because Series Seeds can have the same thing, but generally we will see what we call rolling closings. And in my experience with entrepreneurs and founders, is that they're always raising money. It's like every company, you're always raising money. And so it's one of those things where the note or the safe allows you to continuously raise money. And if you've got an increase in the valuation throughout the term of the rolling closing, you stop the valuation at one point and do a new note at a higher valuation. Second, higher cap. Another advantage of a convertible note or equity is you actually don't value the business at the time you sell the note or the safe. What I mean is, when you do a Series C preferred stock deal, the value of the stock is priced. You've got, we'll give an example. Just say you've got 7 million shares and you do a $7 million pre-money valuation, you've got $1 a share and everything's sold on that. If you do a convertible note or a safe and you put a valuation cap of the 7 million, that's technically not the value of the company. It's just the valuation cap, how that converts. You could possibly convert it at a lower price if you end up doing your price round at a $5 million valuation. So the instrument of a convertible note or safe allows the investor come in, cap the high end of the valuation range, but also protect themselves if there's a lower valuation for whatever reason. The company doesn't meet its milestones, the coronavirus hits and everything changes. So the convertible note and safe is very protective on the investor on the valuation. And as you know, valuating early stage startups is really hard. It's really an art, not a science. And there's so many soft factors in that. And by doing the note or the safe, you have reduced that tension on getting the deal done. You'll negotiate the valuation cap, but you don't have to negotiate the actual valuation. Amir, you were going to say something?
Yeah, I'm saying absolutely. It's really good. So one question I have on that, Larry, that a lot of founders always ask me this question, and I want to hear your thoughts on it. What is considered price round? When is it price round considered that? I generally think Series A, and that's what I say, depends on everyone who agrees on that. So what, in your opinion, consider a legal way of saying price round?
Well, we'll get to that. That's a Series C, SEED. So it's when you actually sell stock, preferred stock, usually Series C or Series A, at a set valuation. So the convertibles, the valuation may have caps and discounts, but it's not set. So the other main advantage of a note or a safe is there tends to be less legal diligence and corporate diligence by the investor. So when you get to a priced round, when you get to a Series Seed round, venture round, you will see. Can you hold 1 second? Sorry about that. I have my 10th grader and her clothes. Okay. All right. So when you get to a real Series A, a real venture round, everything you've done will be diligenced by a lawyer. Every stock issuance, will look at make sure every consultant sign a confidentiality agreement, make sure all your 83B files, like securities, they're going to look at everything you've done for both a legal and a business side. On a Series Seed, you may see a modified level of diligence. When you get to a convertible note or a safe, because they don't really care so much about the cap table, you see less legal diligence. You may still find, it depends upon how big the check somebody's written. If somebody's going to give you $1 million in a convertible note, they're going to do some more diligence. If they're going to give you $50,000, a lot less diligence. And so generally, when I represent investors and doing a convertible note or safe, we'll want to make sure that some basic things are done, like it's been duly incorporated. We'll want to make sure that they've done their securities law filings, and some basic things are in the door. But you're not going to spend 3 weeks or a month where they're doing their diligence to get a deal done, which leads to a much quicker time period to get the deal done. I mean, I got a call Monday from a client. It's got somebody who wants to write them basically $1 million check on a convertible note, and we'll get the money in by Friday. I mean, it's really quick and easy. Okay, next slide. Okay, some disadvantages of convertible notes and equity or safes. So with convertible notes and safes, it can be a little more expensive than a priced round. So for instance, let's just make an example, Amir. You've got a startup and you negotiate with somebody that you're going to have a $5 million cap valuation. And you're thinking this is the valuation, and you're going to put in, just say $500,000, and just roughly we'll just say that's worth $1 per share. If it was a priced round, you would just get your shares for that $1 per share, 500,000 shares. You know what you've got. Everybody knows what you've got. And you just move forward. With a convertible note or a safe, there can be adjustments in that. So for instance, if it's a convertible note, the note will accrue interest over time. So that $500,000, just say it accrues interest at 10%, and it takes the company 2 years to get to their price round and convert it. It's now worth $550,000. So the number of shares that Amir that you just got because it was a convertible note has gone up by 10% over 2 years. So you're actually going to get more shares. Second is if you have another deal that's going to be done. I see some emails here. Another deal that's going to get done and comes in at a $5 million valuation, because you've got a discount, you're actually going to get more shares. And the way that the convertible note or safes work is it's got what we call sort of ratchet anti-dilution, meaning if you had done a priced round, a Series C at the $5 million valuation, $1 per share, and the next round came in, slightly below that or even at that price, you would not really have much anti-dilution for the Series C. But with the discount and the and automatic repricing with the convertible note or safe, the number of shares would be driven higher. Feature of the convertible note or safe that really benefits the investor. That's why it's a lot quicker and easier for the investors to write sometimes these checks for convertible notes and safes, and they're protected if there's any type of down round financing. If it's a note, they get the added interest. So I always want to remind investors that there is sometimes a price paid on a convertible note or safe that you would not see in a priced round if you're happy with the priced round valuation. One other thing, we'll talk about this more later on, is this post-money safes. When Y Combinator came out with the safe a few years ago, it was what we called a post-money, a pre-money safe. And now the form has switched to a post-money safe. And you have to be very cognizant of which form of safe you're using, because they have a significant difference to a founder, an entrepreneur, on how the safes work. And I just want to walk through that just a little bit. And so, if you have a post-money safe, you're going to need to be very, very cognizant of how future money is being raised. So with a pre-money safe, I'll just give you a real basic example. Back to we're talking about a valuation of, we'll use the example, Amir's got a new startup. He negotiates for a $5 million post-money valuation cap for a safe. And he's going to invest, or somebody's going to invest $500,000 in that company. And so that represents 10% of the company economics, right? So no matter what, with the post-money safe, Amir is going to get 10% of that company. And so if the company continues to raise money on that safe, all the dilution of the additional equity or notes or safes that's put in dilutes the founders and does not dilute Amir. When this thing converts, is going to have 10% of the company. That's what he's driven his bargain to be. And the reason why that isn't always the best for the founders is that, in my experience, is founders keep raising more and more money with notes and safes. As I talked about earlier, they can do rolling closing. It can take a year, 2 years to raise additional money. And every dollar you raise dilutes the founder. And what normally would happen is with a pre-money safe is that additional money dilutes everybody pro rata. So if we end up doing, in the example, like that same deal, if you have $5 million pre-money valuation and you end up raising, $1 million, you have, post-money $6 million, 5 million plus 1 is 6 million, and the investors would have 1 million out of the 6 million. So 1/6 of the company in numbers of shares. In the post-money safe, Amir would still get his 10%, and everybody else would share the balance, and that drives the dilution down to the founder. I know I'm giving a quick example because I got a lot to cover. Do people have questions? Is that getting through the difference between a pre-money and a post-money safe?
So Larry, I have a quick question on that. Say, for example, the investors, they know what they're doing and they ask the founder, oh, I need a post-money safe. What are the levers founder can apply to negotiate that deal, and where the assumption is the founder doesn't want the post-money safe?
So when you're raising money, it's all about options. If I'm representing a founder, yep, and they got lots of choices, lots of people want to give them money, then you can pretty much stick to the pre-money safe. If an investor, is very much like, I need the post-money safe, and the amount is not a lot. Just say it's $50,000 and doesn't draw, right. So if the amount was a lot, like say $500,000, I would tell them, let's just price the round. Let's just do a series seed, price the round, get it done, and move on, because the long-term price to you will be a lot more expensive if you do the post-money safe. And versus to do a series seed is more expensive, but it's still pretty cheap. It's a couple $1,000s more. And so, if the check is big enough, say $500,000 or $1 million, but just say 500,000 or even 250, I'd probably encourage them to price the round. If it's small, say 25 or 50, then the founder really needs to understand that this is a toxic, not toxic necessarily, but this is an instrument that is will incentive. give them a high incentive to get to a price round sooner than later.
I see.
Because you want to convert that instrument so it's, one of my philosophies is I like to have investors and founders always aligned. And to me, when you raise additional money into the company, it's good for both founders and investors, and it shouldn't just dilute the founders. And I understand why investors like the post money safe. There's two main benefits for them. Three main benefits. First and foremost is it does push, and investors will tell you this, it does push the founders to get to that price round sooner than later. They want you to get to that price round because it'll hopefully get to that milestone quicker. Two, it secures their deal, right? They know what they got. I gave you, $100,000 and $1 million cap. I got 10% of the company. I know I've got that. And so they really like that protection. And three, there's a tax argument. We'll probably talk about this a little bit later on. There's something called small business stock or 1202 stock. And there's a tax benefit to investors where if you purchase small business stock and you hold the stock for 5 years, and the company is an operating company, and there's certain other restrictions there, but generally those are the main things. Company is a small business company, less than $50 million of assets, which all the startups will be. And if you hold it for 5 years, when you sell the stock, it's right now 100% exclusion from federal capital gains. I'll repeat that again, 100% exclusion from federal capital gains. So if I purchase stock, $100,000 of the small business stock, and there are some caps to it. I'm going to ignore the caps for the moment, but just generally, if I sell that, you hold it for 5 years, sell it for $1 million, I don't pay any federal capital gains. That's a huge benefit for investors. So one of the requirements for that is you buy stock, not buy a convertible. So a convertible note or convertible equity necessarily does not trigger the holding period, the 5-year period on that. There is some tax consultants out there, CPAs out there who say, well, a post money safe qualifies. We can start our holding period. We at Orrick have not come to that conclusion, but there's investors who take that position. And so one of the reasons why they want the post money safe is to get that holding period started for their small business stock. And if you think about it, if you make an investment and you hold it for 5 years, you get this huge benefit. If it's a convertible note and you've held it for 5 years, but it took 2 years to convert it, you only have 3 more years. You only have 3 years then, and so you have to require another 2 more years. So there is an incentive there to get the stock.
I think that's a very good, a great point, because if an investor thinks that way, then either being a founder, either they can ask for more larger check size, or so that they can meet their needs, right?
Yeah, no question. So again, if I'm an investor, and this QSBS is important. It's less important for institutional investors because it's only the QSBS status is for basically only individuals.
I see.
For individual investors or for small funds that basically are pass-throughs, it's an important thing. For larger funds that have already, most of their LPs may be pension funds or non-taxpayers, it's less of an interest. But there are definitely, in my experience, the active investors in the seed and the pre-seed market, this is an important factor to them. And so I do think one of the reasons why like the post money safes. I mean, there's lots of reasons why I like it, but one of it is this QSBS, qualified small business stock category. A couple other things about convertible notes, necessarily not a disadvantage too much, but generally there's going to be a question is what happens if you sell the company and you haven't converted the note or the safe? So you've started the business, you've raised, $1 million of convertible notes or safes. You haven't gotten to a priced round to convert those into the priced round, and you're going to be sold. And that happens a lot more than you think. I've got a client now, we've raised a safe, $500,000 a safe, and they've got an offer from a company to sell them. And it's not a huge win. It's, a couple $1 million, but, today, who knows what, with, the pandemic, what's going to happen. So they may end up doing that deal. So when we get to the safe terms and the note terms, the sophisticated investor will ask for a multiple, 2x, 3x sometimes, even up to 5x, but that's not market. Return on their money, automatic. So that's just something to note as a common term. In my example, just say you've got $500,000 a note and it's a 3x return, that's 1.5 million will go to the note holders, even though that's way below the percentage of the company maybe they'd be entitled to have. A couple other things just to note. Sometimes, not often, but we will see convertible notes have security interests, meaning that the investors will require the company to pledge its assets to secure the notes. It happened to me only one time in my long career where we had a convertible note. I think we were up to about $2 million of convertible notes. The investors wanted it secured. The company could not convert the notes. And basically the lead investor then foreclosed on the company and took the assets, IP of the company in exchange for their notes. And so again, a note is a debt instrument, just like if you borrow money on your house, you secure it. If you default on your mortgage and don't meet the terms, the lender can, foreclose. In this case, they took the IP and they sold the IP to another company. So something to be aware of. It's not equity if it's a note. The most favored nations clause, I don't really see always as a disadvantage, but it's just something that you should know that, basically when you're doing these deals, that you can't really cherry pick, meaning you have to basically give all the investors the same terms on that deal. You can't at the same time tell one investor to get one deal and another investor another deal. You have to treat people the same, and that investors will often look for most favored nations clauses to protect themselves. Other issues with notes, which we'll talk about further later on, is what happens at maturity. So safes don't have maturity, but notes do, and so we often will see long maturity dates. What happens to that note? Does it roll over? Can they, in my example I just gave, could somebody say, pay me? There's lots of issues with a note at maturity, and that needs to be discussed and negotiated. So again, it's not equity, it's debt. The one thing I would note, as you can sort of see through this slide, is that there are lots of issues embedded into notes and safes. And, I always encourage, if you're going to be out there raising money, we see this all the time where people want to save money, be penny wise, sometimes pound foolish, is they'll go onto the website and just like pull off a form without really understanding what the form means. And there's lots of long-term issues that can be embedded into your note or your safe, and not understanding how it impacts you, 6 months from now, how it impacts your next financing is a problem. So we don't recommend just taking a form from the internet and say, let's use this safe, because not all safes are the same. Not all notes are the same. And so really recommend you talking to a lawyer or advisor that understands these terms that can help you walk you through them. Next slide. Amir, next slide. Okay. So the reason why safes developed a few years ago, so the history of this was you had price rounds, that was the standard. And then we had sort of what we call bridge rounds that were generally short-term rounds, 3 to 6 months, and those were always done as convertible notes. And then those deals got extended to be larger deals and longer maturity dates. But we still had these problems of the convertible notes being debt with the interest and so forth. So a few years ago, a concept called convertible equity, Y Combinator came out with safes, 500 startups did KISSes, but there's a whole number of convertible equity instruments. Safes now sort of a common terminology. The principle of the safe over a convertible note is that it's not debt. So if you technically to give potential or somebody your balance sheet and you've got $1 million of convertible notes, technically your balance sheet should indicate that as debt. So you don't have a clean balance sheet. If you've done that as a safe, that goes into the equity column and it's clean. And the safes take away 3 problems with the convertible notes. It takes away no accruing interest, no maturity date, and there's no potential for that security interest that you could do with the note, because it is equity. There is a side benefit for investors that also safe solve. Technically in California, if you are an active investor and you're doing convertible notes, you need to actually register as a California lender. And there's a registration. There's a de minimis exception for like 1 or 2 deals a year, but many investors are very active in the market and will do many more deals than that a year. And so because safes aren't loans, there's no lender requirement, registration requirement if they're doing lots of safes. I know lots of investors ignore that, but it is a potential issue that the safes solve over a note. Okay, next slide. Okay. Some disadvantages of the safe that people should be aware of. We already talked about it a little bit. So typically, if you have a safe or a convertible note, you don't start your holding period. For small business stock, there is that debate I mentioned about post-money safes do trigger it. There's no consensus whether that's correct or not. It is a newer form of security. And so out here in San Francisco, in the Silicon Valley Bay Area, many investors are very familiar and comfortable with safes. But outside of the Bay Area, it's less known. Most people don't know what it is and aren't very comfortable with it. I have another client that we raised about $500,000 of safes from local investors. And as soon as he went outside, the founder was a man, outside the Bay Area, he was having significant pushback on it. And I think internationally, like if you were going to raise money from international investors, it's really confusing to them, what this safe is. So there is that tension here. What is it? I'd rather have something I know. I want a convertible note or a priced round. Amir, I'm not sure whether in your experience, because you guys see maybe some more international deals, but I don't think there's an equivalent concept anywhere else in the world to a safe. It's just really
No,
a U.S.
there is not.
US
I
yeah.
mean, Europe kind of trying to do it, but they haven't actually finalized anything at this point. But nothing in Asia at this point, nothing yet.
So if you were gonna, if I would recommend to investors, if your investor base is really non-US, I think the safes would be really hard sell. I think if it's primarily area or with investors who are very active in the seed pre-seed market, not an issue. Um, but if you're going to not those types of investors, expect to get some pushback on it. I see a question. How about New York City and Boston? I think those markets are generally fine if it's, again, investors who are active in the pre-seed seed market. I represent a number of investors from New York, and they are always out in Silicon Valley, and they're doing lots of deals, and they do lots of safes. Um, that said, I do think New York investors come more out of the private equity space, and it's harder for some of that, people with that experience to do the saves. I think they'd rather have the convertible note or a priced round. A couple other things that you should note if you're going to go do a safe, and I point these out mainly because the starting point is often you use a Y Combinator safe. And again, there's the pre-money safe and the post-money safe. But on these terms, neither one often deal with these problems. So when I represent an investor doing a seed investment, and again, if it's a $25,000, $50,000 check, I may not care about these issues. But if it's a larger check size, 250, 500, some real money being put to work, I will want to have these rights. So these rights are not built into the safe forms generally. Investor information rights, investor inspection rights, investor rights to participate in future financings necessarily. A most favored nations clause, meaning you're not going to give a safe on better terms than the terms I'm getting. And sometimes we'll ask for some additional reps and warranties that the safes don't have. And so often when I'm representing companies that are doing safes, we'll walk through the safe form and sometimes build into the safe form some of these basic rights. So we cut off comments because it's more expensive often to do a bunch of side letters or mend the safe. And now we have two safes that are not matching, than to basically give some basic investor protections that shouldn't be a problem right in the investment in the safe to satisfy these questions. And these rights, like the information inspection rights and rights to participate, you wouldn't give that to somebody writing you a $25,000 check, but you may give those rights to somebody writing you a $500,000 check or a $250 check or $1 million check. So there's what we call a major investor status, and we will tie those rights to the level of investment. Next slide. Next slide. Okay. Why Series Seed? So again, Series Seed preferred stock is a priced round. So the first two, convertible notes and convertible equity or safes, those somebody puts in $100,000, and if and when you do a priced round, it will convert into the priced round. So instead of doing the convertibles, let's just do the deal. And so why do we do a Series C? It's there's no interest like a convertible note. There's no discounts. Basically, you'll know what each side gets. The company will sell blank shares for set of money. So it's basically the deal is set, and you can move forward. It's equity, so the balance sheet is clean. Now, one advantage of the Series C versus a Series A is like the convertible note equity, it's designed to be pretty fast and quick. It's not a full-blown venture round. So if you are doing a full-blown venture round, a Series A preferred stock round, you would see lots of documents, investor rights agreements, voting agreements, rights of first pursuit, co-sale agreements, a lengthy charter agreement, a very lengthy Series A purchase agreement with lots of reps and warranties. If you look at the National Venture Capital Association, the NVCA venture capital forms, they're all online and they're free. There's probably like 200 pages of documents, maybe 250 pages of documents. They're really great documents. They're very well thought of, but it takes a lot of time and energy to do a venture deal. So the Series C deal basically is a much shorter, abbreviated set of documents that give basic investor rights. It allows you to price the deal and give the investor preferred stock. So it's more complicated than the note and the safe, which is just a few pages long usually. One or two documents. The Series C would be usually a purchase agreement, a charter amendment. Sometimes they have another document. This depends which law firm is doing the document. There's a great website called seriesc.com. I think they've got it down to 2 documents. Longer than a note, a safe, but instead of 300 pages of documents, you may have 20 pages of documents or 15 pages of documents. And they're set up pretty much to be as cookie cutter as you can get them. So they're pretty fast. They're relatively cheap, much cheaper than a full-blown Series A, but still a little more expensive. Okay, so because it's shorter, you don't have all the full-blown rights of a Series A. So the investors, still take some. Understand that they're going to have to wait to the Series A to get all their rights, and it does, lock in the 1202 small business stock time period. Next slide. Okay. So some common basic disadvantages of a Series C is obviously it's a little more expensive. I put in 2x in time legal costs. Again, that cost number and the time period is really dependent upon how much negotiation there is between the company and the investor. Most law firms, big law firms like Orrick, there's also the seriesc.com site, have fairly standardized documents. And so if we're working with an investor that's got, good counsel that knows what they're doing, they'll know our documents and know, so it's usually pretty quick and fast. But there could be somebody who's not as familiar with it, and we'll start negotiating some of these rights. So the cost factor on the Series C really depends upon the investment level, an investor's level of their counsel and how much legal diligence they're going to do. And that cost could be more than 2x, it could be 5x, or it could be closer to the same cost. It just depends upon the level of diligence and negotiation. But I generally tell clients, if they ask me the difference in cost, just be probably 2x, and probably a little bit, if I get a convertible note done in a week, the C deal will take 2 weeks. Any questions so far? All right. So one of the other main issues with the Series C is it forces the valuation. And so as we get into these deals, you have to get to a valuation. And when we're looking at a convertible note or safe, if you have a very low cap, so just for example, the cap is $2.5 million, and the person's going to give you a sizable check of $500,000. I might as well just do the Series C, because that you're basically, the cap is the valuation because it's so low. If you've got a really high cap, $20 million cap, $15 million cap, but if you were going to price the round today, you'd be hard. They may want a much lower price. So again, it's going to force that valuation. One of the common things I get from clients is, well, I'm going to have my friend price the round. I'm going to have somebody friendly price the round. That could work if the person is truly, can have the sophistication to lead. Seed investment. We generally want to have a lead investor, somebody that other investors will say, okay, this price seems fair. They know what they were doing. I wouldn't have, somebody, putting in $25,000 and saying, this is the price of the round, because you're not going to have sophisticated investors maybe agree on that price. And the last thing you want to do is do a Series seed and then have to amend the documents and change the price. That's a lot of work. So that's something that you don't want to do. Sometimes the lead investor will want a board seat, depends upon how much money they're putting in. And then they'll have these other rights set in that aren't always set in the safes and notes. But sophisticated investors, I mentioned, will want these. Let's go next slide. Okay. So what are the key terms that you'll see in a safe or a note? So when we do safes, I always recommend that our clients put together a basic term sheet. And this helps for the client to understand what the deal is, as well as the investor. And the reason is, without a term sheet, you don't really know what's going on. And without a term sheet, if you just send somebody a safe or a note, you're requiring them to read through the document, and they may not understand it. So some of the key terms for a safe or note is, how much money are you really trying to raise? And I always recommend putting a little bit more than you think you need, because as you know, raising money start up always seems to take longer and cost more. So if you think you need to raise only $500,000 of notes or safes, I'd recommend building in $750. So you want to build in a little cushion. We always see with safes and notes rolling closings. We usually allow rolling closings for up to 180 days. We've got clients that go longer. You sometimes see a minimum raise, something like, got to have $500,000. We're not going to issue any money. We don't see that a lot, but we do see that from time to time. Another key term in these notes and safes is what we call the financing conversion trigger. This is the amount of money you need to raise to trigger the conversion. Generally, the market number is 2 million. Can be a little lower, can be a little higher, depends upon factors of the company. And what investors want is that you're not going to just raise, $100,000 or $50,000 and convert their note into that round at that price. The investors want to see a real financing amount with a real investor who would have negotiated, real rights for the investors. Okay. Interest rates on notes, most common is 8%, but I've seen as low as 2 or 3%. I've never seen anything really higher than 10. Investors are not investing these convertible notes for the interest. They're investing in it because of the upside of the business. I often will start with 5% go to 8% sometimes. Maturity dates, the longer the better for entrepreneurs. And this is again for convertible notes only. When we first came out with these, we'd often see 6 months. Then they went to a year. Now we see 24 months is pretty common. There is that the lender issue on registration for notes longer than 12 months because that could require a registration for them. Discounts on conversion, market is 20%. They often range from 10 to 30. I've seen clients get will use the discount in different ways to attract investors. For instance, the first $5 million or first $500,000 of investment will have maybe a higher discount, and the next 500,000 would have a lower discount, and then the next 500 would have even a lower. So they tranche the discounts based upon how much you raise, trying to give the persons who come in earlier that have the higher risk more of a discount. The conversion cap is just whatever is negotiated based upon the company. And remember, the way that the conversion works is that the conversion of the note into the instrument will be at the lower of the price determined by the discount or the conversion cap. So real quickly, if you have a $5 million conversion cap, that will be the price per share will be based upon that 5 million, unless the discount gives you a lower number. So if you did a financing priced around at the 5 million, 20% of 5 million would give you basically a $4 million valuation. You would use that to determine the conversion price. So basically, you'd have to do your priced round 20% higher than the cap to start to get to the cap. Otherwise, the discount will give you a lower number. One of the issues is when you sell the company, you haven't converted it, is what's the return? We've talked about that. Usually, there's a premium on that. Next slide, real quick. We're running out of time. I think I'm going to skip this slide, but the only thing to note is sometimes, if you go back for 1 second. So just the one thing I would note is sometimes you will see with convertible notes, if you've got a sophisticated investor, them asking for some negative covenants, meaning that company can't do these without their consent. Mostly they relate to no new security interests, so something called a negative pledge, no additional debt without consent, and they may ask for security. On occasion, we'll see a board seat or a board observer right, but that's not very market these days. Okay, next one. Next slide. This happens a lot where you basically have come up with a valuation cap and a discount, and still you have an investor who says, this is not enough. I need a lower cap or lower discount. As I mentioned, you can't give somebody really a special deal. There's lots of securities law issues with it. However, if the investor can really add value to your business and would be an advisor to you or maybe join your board, you can give them within market some type of advisor equity. And my only point is, you need to understand that everything you do will need to be disclosed to other investors. So don't try to do things that you have to be honest, and you're going to need to disclose it. So if you're going to go give an investor some advisor equity, it's got to be reasonable and something within the what you give other advisors. Next slide. Just a couple things to note about safes. There's the Y Combinator form. We've talked about that. All the law firms like Orrick have their own forms. 500 serve form, the KISS form. I like that form actually. It's a fairly neutral form. One thing to note is just because you have the form of agreement doesn't mean it's done right. So to properly issue any convertible, you're going to need to do securities law filings with the states, potentially a Reg D filing with the SEC. You have to get board consents. And if you don't follow these practices and get them done right, it can be problems for your venture rounds. It can lead to rescission rights. It leads to lots of issues. So again, make sure you talk to a lawyer if you're going to do these things, because if you do it wrong, it actually creates problems later on. Next slide. So this slide was just briefly talking about some of the key rights for a Series C financing. I think we'll just skip it. Basically, the Series C is going to have basic preferred stock rights, but not all the rights. The last thing I had, just briefly, you got to make sure we talk about this for a moment, is whenever you issue stock in the United States, and I'm sure it's the same in most places in the world, you need to issue it in compliance with applicable securities laws. In the United States, we have both federal SEC law rules and state rules. Each state has their own securities law. It comes from way back in the 1920s, where people were selling stock, and people would say, I can sell stock in the sky. So I could sell the blue sky, and people would buy shares in it. So the state securities laws came into play first to stop people from selling stock in the sky, and they're still called the blue sky laws. So they're just state securities laws. But in general, when in the United States, if you're issuing or selling securities, and a safe is a security, a convertible note's a security, obviously a Series C is a security, you need to comply with these laws. And either you're going to need to register the stock or the security, the note or the safe, or find an exemption. You're obviously not going to register them, because you're not going to, registration means going public. That's a long, expensive process. You're not going to do that. So you're going to be selling them under exemptions. The most common exemption that we see for seed financing in the United States is what we call a Reg D offering, Rule 506. And with that rule, there are some requirements. And so we're going to really emphasize three things really important. No general solicitations. So what does that mean? That means you can't be putting onto your website, I'm selling stock. If you're interested in buying stock, email me. You can't be doing social media, doing a stock offering. You're not supposed to be going to conferences saying, I'm selling stock, please call me. Those all be deemed general solicitations. Okay. And the SEC, could easily check into that. Now, there is a methodology with a Reg D offering that you can do a general solicitation. There are lots of rules on that, and I'm not going to get into it today. But if somebody says, "Oh, that lawyer doesn't really talk about," you can do one. You can do one under Rule 506C. There are additional restrictions on it. Two is that please keep your investors to accredited investors. I get this question all the time. Well, why can't I have, a friend of mine give me $15,000 even though he's not accredited? So that investor could blow your whole offering. And within the rules, in the Reg D rules, there's basically a requirement to do a very lengthy disclosure document, almost like an S1 for non-accredited investors. So no one does those. It's way too expensive. So please keep it to only accredited investors. Three is there's going to be required securities law filings. There's going to be a Form D with the SEC. In California, there's always a filing, usually a 25102F filing, but wherever your investors are, it's not where the company is. Where the investors are will trigger which state laws you have to comply with. The last is don't use unregistered brokers. You're going to have to disclose in your Form D, create lots of issues. We could do another session about, talking about unregistered brokers, but an unregistered broker in California can create lots of issues for you. Okay. I know I went a little long. Do people have questions? I feel I've talked a lot, and this is more of a conversation for me.
I do have a question when it comes down to a lot of folks reach out to me and others that I've seen over LinkedIn. Oh, we were looking for investment. Can you, this is our pitch deck. This is our one pager. Like, is it legal to do so? Number one, and number two, because it really doesn't work in a lot of cases. But that's something I want to understand that.
Well, is that legal to do it? So does the person? So that could be yes or no. So if they're just sending that out to lot of people, like they don't even know the people, there's no pre-existing relationship with the person, then that could be deemed to be a general solicitation. Now, if you are connected to the person knows you or knows you through another contact, and they're being more targeted and solicited, meaning that and you can get pre-existing. So the terminology on general solicitation is there often a pre-existing relationship, and you can get that directly or indirectly. So, for instance, we often will be asked to make introductions, and we do that all the time. And the way that will work is these potential. We've worked with them before, so we have a pre-existing relationship with them, and so we're connecting the two, and we don't get a fee for that, right? So it's just pure introduction. So somebody is just sending you out of the blue something, it's okay, but if they're sending it out to probably, so there's a range. If they're like, and this is something that you're already connected to on LinkedIn.
No, actually, that's LinkedIn, when someone connects with you, there is a feature where they can write a small message. And a lot of people do that, and a lot of people the other way around, where they just connect with you first and then they send it. So, I mean, and this is, people should think about, like,
If I was representing that company, I would want to have a discussion with that person, because it could be a general solicitation.
Okay.
If the person, to you, and had some connection with you, then maybe it's fine. But if there's no connection, 1,000 people, it feels like a general solicitation, doesn't it?
Yeah, but what about the general solicitation for common stock versus just for the safe offering, right? So as you mentioned a little bit earlier, if I'm saying I'm selling stock in my company, that's a different situation. But I'm just looking for investment. For example, a lot of these founders on here today, if they're just looking for investment, and let's say as a safe offering or something like that, would that be like note up? How does that differentiates?
It's all the same. Common stock, notes,
Okay.
they're all securities. They're all securities. You all have to comply with the securities law. So it doesn't really matter the form of the security. You saw this. We saw this a lot with the tokens, right?
Yeah.
2 years ago, 3 years ago, a year and a half ago, we had the big token rush where everybody was trying to do an ICU or a token offering, and they were making arguments that the tokens weren't securities. And the SEC was no, these are securities. So it doesn't matter what you call it. If it's basically an investment contract, basically an instrument that is made for investment, and there's something called the Howey test. I'm not going to get into all that, but everything we're talking about, they're securities. You need to comply with the securities laws. And I've had a client who, despite very clear advice, not to post things on their website and not to do certain things, did them, and the SEC did an investigation, and they had to basically return all the money and paid a lot of money about it. I mean, you got to be very, if you're raising money, you have to understand there are laws and rules on it, and they do apply. And to the extent you are taking money from people you don't know, there's a higher risk.
Yeah, and I would say common
Yeah.
sense prevails. Like if you are an investor individually, and would you like those kind of approaches from the people that you do not know? Will you entertain? The same way it goes on the other side as well. So being a founder, I think work with the existing relationships and the people that you know already. So I think those approaches at the very initial stages, at least, it works. Um, and that's a kind of common sense approach.
I think you had I mean, the issue that you run into is raising money is really hard. And, and I find investors are often lemmings, meaning that you could be trying to raise money for a year to 2 years and get nowhere. And then you find one person who just loves your idea and they invest. And now a whole bunch of other investors come in, right? And you see that all the time where you find that one and then you can raise a fair amount of money. So there's this tension here of doing anything to raise money, and until you get to that point, it's really hard. And so you meaning the entrepreneur, you run into somebody who say, "Hey, I can introduce you to these 10 people, but pay me a 20% fee, even if they're not registered broker dealer." Or, I've got all these people who are going to write me $5,000 checks and they can get me to the next stage. All those things have issues and consequences. And if you don't follow the securities laws, the people who are, and the company fails, you can have some real personal liability and risk there. So it's
I think we are a little over 18 minutes over time. Amir, if anybody has not submitted the questions, I think we can wrap it up with some closing thoughts.
If there's any closing thoughts you want to provide or anything that we're missing, that should we go over?
No, I just appreciate it. People have questions correctly. I normally do this live and have a great conversation. And usually one of these issues are coming up for somebody directly. But again, if people have questions, just email me. More than happy to answer them. And the main thing is when you're raising money, talk to your lawyer or talk to an advisor who's done this many times before, and don't always trust what you read on the internet as being right, and don't always trust to say people do this all the time, because a lot of people do it wrong, and things matter, they matter. And again, I gave you the example where my client put stuff on the internet saying, I'm trying to sell stock, thinking that SEC would never find out. And guess what? It was found out. And, they had 6 months of living hell. So, you got to take these rules seriously.
Hi, Larry. This is Rohit. One last question, if I'm allowed to ask.
Yes.
Okay. Are you helping startups with the IDL and PPP applications?
We have a whole task force on the COVID crisis that's helping clients with questions throughout it. We actually aren't doing the actual applications. If that the question was, help you with the actual application.
Right.
No, I don't think you know, we definitely have a whole team that's totally on top of it, answering questions. But we're not actually, you know, that would be more like a CPA or an accountant that would help you with those questions
Correct. Thank you.
about the applications. There, yeah, but there's been lots of you know, press about the PPA, which we could talk about at a different time. I would encourage you to go to our
Last thoughts.
Larry, where? Encourage you to go where?
So if you've got questions about the COVID crisis, we've got a really excellent website that is talking from the PPA to the loans to how to restart your business to what you can do. I mean, it's comprehensive and it's international. So it provides, you know, sources, because I know you guys have a number of companies in your program that are international also. If you go to Orrick.com, www.orrick.com, I can send you the link, but there's a daily update every day of what's going on with the new rules. And then once a week, there's a webinar. I think there's one tomorrow again. There's a webinar. We're talking about, you know, steps companies are going to need to do to reopen and from cleaning to just, you know, all the steps you're going to probably see when you finally reopen. Again, hopefully we'll have a reopening in the next couple of weeks.
Thank you.
Or June 1st, I hope.
Awesome. Thanks, everyone. We're going to have a similar, another topic that we're discussing, VC fundraising part 2 with Larry next week, same time. So I'll be sending the links to you guys later today and posting on LinkedIn. Feel free to join. And thank you so much, Larry, for sharing your thoughts. I mean, this was very, very, like, I would say this knowledge was very, you know, important to know if anyone who's actually raising capital.
Yeah, I call it as a technical details.
It's technical, I agree. But hopefully,
but you need to know these technical details if you're raising capital, you know.
Yes. That
Okay.
will give you the leverage to negotiate or maneuver, whatever. Yep, I totally agree. Thank you, Larry.
my pleasure, guys. Have a nice day. Good luck, everybody, today.
Larry.